Real estate investors will always tell you two things. Number one, it's always a great time to buy. And number two, location, location, location. But for the market today, the sentiment was all about rotation, 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 out of technology and into everything else. As weaker yields and a weaker dollar saw the equal weight small caps and mid caps participating over the S&P 500 and the Nasdaq as a whole. So the question remains, why didn't technology participate? Are we about to enter the rotation trade? And if so, where do we want to be positioned for maximum alpha? Today, we're going to discuss that and earnings. We had a crazy day of earnings and there were some winners and there were some very, very big losers. So we're going to talk about all the big names and what it means for their respective sectors. We're also going to be talking about seasonality for the S&P 500 as well as the 10-year yield and our expectations for the rest of 2024. And we also need to talk about sector composition. Apple is now the third biggest stock in the world. You know exactly what took its place. Now, is Nvidia coming for Microsoft to be the biggest stock in the world? And what implications will this have for the markets? That's what we're going to talk about here today. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video and leave a comment for the algorithm. Let's get into it. Now, this is the daily heat map of the S&P 500 and we can see some very, very glaring things. Excluding Apple, which returned 0.5% for the day, this entire section of the market was very, very red. Pretty much tech, comm services, software, everything else was really, really green. If you're holding the RSP, a great day. Excluding a couple of earnings names, but it was a very, very good day. I mean, in consumer defensives, healthcare, industrials, real estate, energy, every single sector was in the red today, except for, the big technology sectors. Look at software down 5.78% today. And I think the pain's going to continue after some of the software earnings we got, and we're going to talk about them a little later on in the video. We also saw tech down 2.28%. Again, that's Salesforce earnings affecting overall technology sentiment and the fact that technology had also led the pack throughout May and they're coming under a bit of pressure. We also saw semiconductors down 1.38%. Very similar situation. They had run up a lot, but it's pulling back. We saw the SPY was down 0.66%. And it's kind of crazy that just these three sectors have such a big pull on the SPY. Communication services was actually down 0.33%. And then every other sector was green. We actually saw rate sensitive sectors form really, really well today. Look at ITB, look at KRE, XLRE. Then we actually saw utilities, metals, minings, the material sectors and GDX up the top. So rate sensitive, commodity sensitive sectors were the real winners today. So if you were in these sectors, your portfolio's done really, really well. And then everything else after that, XLI, XLY, XLF, XLE, XLP. And the reason why we actually saw a really upbeat action across the broad market today had to actually do with the data we got pre-market. So we got core personal consumption expenditures quarter over quarter, the seasonally adjusted figures. The consensus was for 3.7. We actually got 3.6. When this data got released, the S&P 500 ripped up 40 points immediately. We also got GDP data, which came in line 1.3%. Against the consensus of 1.3%, and then the price index of 3.1% versus the 3.1% expectation. We also saw initial jobless claim came in pretty much in line, a 1,000 point miss, but really inconsequential. And then we actually saw personal consumption expenditures, the core version of it. Sorry, this is the headline version. This is the core version, came in at 3.3%. And I think BOFA's expectation was actually 3.4%. It was unchanged on a sequential basis. So, we had cooler PCE data, inline GDP data, and the market really liked that. And the broad market was actually really, really upbeat on all of this data. We saw the RSP was up nearly 0.5 percentage point here today. Mid caps 1%, the SP 600 up 1.12%, and the IWM up 0.95%. So definitely the broader market rallying in light of all of this. The S&P 500 was down 0.6%. The Nasdaq 100 was actually down 1.06%, led by the mega caps, semiconductors and software. And then the Dow Jones was actually down 0.86%. And that was largely due to CRM. Salesforce shaved 275 points off the Dow. A brutal day there for the Dow simply because of one stock. And that's what happens when you price weight indices and you have a major stock like RSP, which is one of the biggest price stocks in that index. Now, it was a brutal day for growth, down 1.55%, but actually upbeat here in extended hours, up 0.73%. Value definitely won today. So it was value over growth. And when the data released pre-market, yields actually fell significantly The yields were down 1.43% here today, and the lows of the day finishing at yesterday's open. So we're going to see if we're going to actually get a continuation towards the 4.5% area, or if we're just going to trend sideways here for yields. But very interesting trade. That's exactly what I said at the start of the week. A lot's going to be dependent on this data. If the data comes in good, the market's going to rally, and we definitely saw that with the RSP today. As a result of yields falling, bonds did gain. We saw Bitcoin and crypto risk assets did gain again today, up 1.16%, but that's fairly light volatility. But it does look like Bitcoin's trying to like form a low right here to move into all-time highs. We'll see if they can do it. I think that's going to happen, and we should see all-time highs in Bitcoin. Gold was relatively flat for the day. Silver did move down. Looks like we're forming a double top, but as long as silver can actually put in a low above this $30 area, right, we should see silver continue to make all-time highs and continue the blockbuster rally we've seen year to date. I believe silver is up 31% year to date. Absolutely crazy. What also helped stocks as a whole was that the dollar did fall along with yields falling, and that's just really, really good for corporate profits. A lower dollar means companies can trade international currency for dollars at a higher clip. That's exactly what you want. It's good for earnings, good for Q2 earnings. And then oil actually fell 1.67%. So a brutal day for oil, but that's coming off a very solid early start to the week and still up overall. Now let's dive into market breadth. Now we do know the RSP actually gained, and we can actually see here that over the last few days, even the last week or so, market breadth has actually deteriorated significantly in both the 20, 50, and 200-day moving average. Now, stocks above the 200-day moving average is not something we should really be worried about, simply because a healthy trend is anything above the 55% mark, right? So 55% of stocks or above. Right now, we're sitting at 65. So even though stocks above the 200-day has been deteriorating, the long-term trend is still intact. What we should be worried about is stocks above the 20-day and 50-day. This has deteriorated significantly from above the 55% mark into the 28.82, 42.34. So 28% of stocks above their 20-day, 42% of stocks above their 50-day. But we are starting to see a bit of life come into these markets. We saw that here on Tuesday for both breadth indicators, and we're seeing that here again. And after today's trade, especially what we saw in the RSP, it looks like we are starting to form a bottom here in breadth momentum. And if that is the case, we will see the market move higher, particularly the equal weight market, mid caps and small caps. Maybe not so much the S&P 500 and Nasdaq, especially if the bigger names come under pressure with valuation concerns and the fact that we are rotating, pretty much away from some of these big names into the broader market. We should see a bottom form out, and as long as breadth mechanics remain positive, eventually the S&P 500 will catch up. So overall, breadth still looking really, really shaky. But the thing is, we do know it's been deteriorating. Now we just want to look for a bottom. We just want to see continuation for further upside in the market. Now let's dive into the S&P 500. So very, very quickly, the S&P 500 again put up a red day. The advanced decline line actually moved up. So a bit of a positive divergence there. Yet in yesterday's live stream and for the week throughout, I said if we don't find support at 5250, what we're going to do is slice right through this line, and we're probably going to go to the 5200 area. And I remain convicted on that fact. I do think that the S&P 500 is going to probably continue to move down to this 5200 area. I think while small caps and the broader market actually continues to trade sideways or slightly move up, we can see that the RSP, I said this line right here, the 163 line, is the line they need to hold. It does look like the RSP is holding that line. We actually closed slightly above it. So in tomorrow's trade, maybe we continue the sideways trade, move slightly up, close this gap, and then continue the rally, break some of these highs, hit new all-time highs in the weeks ahead. We've officially exited the window of weakness. As long as we're in positive gamma, dealer positioning will be on our side. If we're in negative gamma, dealer positioning won't be on our side, unfortunately. Right now, the gamma flip zone is at the exact same place it was at the start of the week at about the 5300 level for the S&P 500. So that's what I'm favoring. I'm favoring sort of like a move into this area here tomorrow, and then next week, we continue to move higher, get back into positive gamma, and then break new all-time highs. Maybe towards the end of the week, maybe the start of the week after, we could see that happening. I do favor strong support to come at the 5200 area. And for the RSP, I think the broader market's actually going to continue to rally. I think PCE is definitely going to come in cool, and that's going to support the overall market for the most part. But now let's talk about earnings, guys. So Thursday, we actually had a pretty dense day of earnings here. I saw Footlocker was up 27%. Best Buy was up 10% in pre-market. So the market must have liked their earnings. We're going to dive into Costco and DELL in detail today. But ZScaler was up like 17, 18% or 13% in after hours. Really good earnings. The market liked what they saw there. I didn't get to see what Marvell did. MongoDB was down like 18%. It was a rough go. Then Ulta Beauty was up 7%, and then Sentinel One was down like 12%. I think Veeva was also down like 14% as well. So a lot of these tech names getting absolutely hammered. And I think that has to do with valuation against earnings. But let's actually dive into Costco, see what they did. Now, Costco reported EPS of $3.78. They beat expectation, but missed on revenue of $57.39 billion against $58 billion. But they actually opened 25 stores year over year since the same quarter last year. Comparable stores in the US was up 6%. The company sales saw plus 6.5%, and then e-commerce plus 20.7% here. So the market just didn't like this revenue situation with Costco. It was down like 1.5%. It also trades on like 50 times. So, you know, if you are going to get a revenue miss, you are going to see the stock sell off, but it didn't sell off as much as Dell did. Dell actually hit a double beat. You can see they reported 22.2 billion against 21.61. That was a 6% growth year over year. And then EPS, they came in at 127. The market was expecting 124. That was actually a 3% loss year over year, but still beating market expectations. And we were talking about this in the live stream. I just didn't see why Dell was rallying. You know, I think it had to do with obviously their server segment, but that growth is decelerating. Also, they guided lower for the next quarter. Market was expecting 58 cents in earnings per share. They guided for 46 to 49 cents. So yeah, things falling apart here for Dell. They were down 18% in the pre-market, and we're going to see how sentiment is going to affect all of the other semiconductor proxy plays. Yeah, things definitely unraveling here for Dell. I think, you know, everything was really dependent on this guide lower. The market didn't really care that year over year EPS fell because the expectation for it to actually fall more. It's just the guidance. Not good at all. That's a huge guidance miss, by the way. So very mixed day of Thursday earnings, some winners, some very big losers. That's how the market goes. Looking at the AA sentiment survey, what direction do AA members feel the stock market will be in the next 6 months? And we're seeing quite a change here from last week. We saw 47% of sentiment votes were bullish, now down to 39%. And we saw the same amount of bearish sentiment votes as we did last week in this week's poll. And this is very, very telling. It pretty much tells us that those that were bullish have gone into the neutral camp, and those that were bearish have roughly remained the same. There's been a tiny adjustment here, but inconsequential in the grand scheme of things. Now, as market indices have come under pressure, bullish sentiment has actually waned. But if you actually look at the historical averages, you can see that bullish sentiment votes is still largely above the historical average, and bearish sentiment votes are still below the historical average, with neutral sitting roughly in the middle. So it's not anything to get worried about or ride home about. When you start to see bearish sentiment above bullish sentiment, that's when you can really see some major moves in the market, because that is a real shift in sentiment. And oftentimes that can lead to further downside action in the S&P 500. But until we actually get that, I remain constructively bullish in the long term. In the same way that sentiment has shifted, so too has sector composition for the S&P 500. Nvidia is officially the second biggest stock in the world. In the S&P 500, it makes up 6.3% of the index, right behind Apple. And this goes to show the changing landscape in the ever-changing market. 1 year ago, had you told someone Nvidia would overtake Apple as the second biggest stock in the world, most people wouldn't believe you. And again, this goes to show where the world is going and the overall sentiment and expectation on artificial intelligence. Everything else, it remains as it is. Amazon in fourth, and then Meta, Google, Berkshire, Eli Lilly, and Broadcom. And kind of crazy to actually see Berkshire sitting at that number 8 position at 1.65% of the S&P 500. Now let's actually dive into some seasonal stats. We've had a very bullish year to date in the S&P 500, up about 11% into May. And normally when January to May returns greater than 8%, this is what we can expect in the month of June. Normally the average return is 2.34%, 14 wins, 3 losses. Very, very bullish stuff right here. And if you actually look at recent history, 2019, 2021, 2023, in 2 of those years, they were above 6%, and all 3 of those years was above the 2% mark. So we can actually expect some bullish momentum here in June, even as we've rallied significantly year to date, because momentum brings momentum. That doesn't mean we can't actually get a red month. We definitely can. It's just more likely that the probabilities are on the side of the bulls. Now, a big part of why the S&P 500 is actually up almost 11% year to date has to do with earnings. Earnings have come in very, very good, and the rest of the world hasn't quite followed. You can actually see that European earnings, this is the Stock 600 index, Europe's equivalent of the S&P 500. Right now, we're looking at negative earnings growth of 2.3% compared to the same quarter last year. year and we've had some very, very shocking sectors. Look at real estate, look at industrials, look at energy, and look at basic materials, all down more than 20% year over year in earnings growth. Maybe they were coming off tough comparables, but still very, very vicious earnings growth. The best sector year was actually financials, up 15.9% year over year. So there are some bullish sectors nonetheless. And look at revenue growth, down 4.1% on a year over year basis, with the best sector again being financials, up 7.9%, and everything else either being declining or slightly positive, 1.4% in industrials, 2% here in real estate. But we all kind of knew that Q1 was actually going to be an inflection quarter here for the Stock 600. It's really in the second, third, and fourth quarter when things really get interesting for this index. In the second quarter, we're expected to see 1.3% growth in the Stock 600, and then double-digit growth for the third quarter, as well as the fourth quarter of 12.1 and 11.2%, which should result in a full calendar year growth rate of 4.4% for the Stock 600 index, with every single sector reporting positive earnings growth except for consumer cyclicals and utilities. Now, where does that leave us with valuation with regards to Europe? Now, Europe trades at a 12-month forward price to earnings multiple of 11.7, and if we actually exclude the granolas, it trades at 11.1. Now, the granolas refers to the 11 stocks, which are GSK, Roche Holdings, Nestle, Novartis, Novo Nordisk, L'Oreal, LVMH, AstraZeneca, SAP, and Sanofi. If you actually exclude those, you actually trade at 11.1, but you probably do want these stocks, and I would actually look at this right here if you are going to get into Europe, because these stocks, stuff like ASML, Novo Nordisk, L'Oreal, LVMH, they are the growth drivers in the Stock 600 and in the European indices. Looking at stuff like the UK, that's trading at 10 times and is actually well below its historical average. And then looking at the world overall, 15.5 times is what the global market trades at, mostly boosted by the US market. This is the equal weight, trades at 18.5 times, and then US ex big tech trades at 16 times. So very reasonable valuations across the board. You can even look at stuff like Japan trading at 14.3 times, Asia ex Japan 12.4 times. And again, it's a great time to be in stocks because valuations are fairly reasonable. There's just a few concentrated big technology names in both Europe and US that's really boosting the overall valuation of these indices. But if you dive down into the specifics, everything is looking fairly reasonable, especially on an equal weight basis and outside the US. Now, with US valuations looking fairly reasonable at 16 and 18.5 times, what are price targets we can look to in 12 months? Now, Morgan Stanley have done the work for us. So they're looking at S&P 500 price targets into mid-year 2025. They got a bull case, base case, and a bear case. Now, their base case is $283 in earnings per share at a 19 multiple. That would mean the S&P 500 trades at 5,400, and that's an upside of 1.8%. So pretty much their base case is S&P 500 trades flat, slightly up in the next year. Looking at their bear case, they say S&P 500 at 228 earnings per share, which is ridiculous because $224 is what we did in 2023. So at $228 per share, 18.5 times, the S&P 500 trades at 4,200, and that would represent downside of 20% in the S&P 500. These predictions were done when the S&P 500 traded at 53.05. Now, the bull case, if the S&P 500 reports $298 in earnings and trades at 21 times, which is the current market cap weighted multiple, that would mean the S&P 500's price target is $63.50, and that would be upside of 19.7%. So very, very bullish on the bull case, very, very bearish on the bear case, fairly neutral here on the base case. Kind of crazy when you look at it, but it's not all that crazy because that's what the S&P 500 trades at right now. And if earnings continue to beat expectations and we get 298 in earnings, we could definitely see 63.50 in the S&P 500. It's simple math. 298 multiplied by 21.3 equals 63.50, but that's dependent on if we do get those earnings and if multiples do expand into 21.3. So if you're a bull, this is what you should be looking at. If you're a bear, this is what you should be looking at. So pick your poison. But these price targets are largely hypothetical scenarios. We don't really know what's going to happen in the future, but we can talk about the here and now. And in the last 3 months, the S&P 500 has returned 5%, And of that 5%, 81% of that return has been driven by earnings. 19% of that return has actually been driven by valuation, compared to the utility sector, which in the same 3-month period has returned 15%. And of that 15% return, only 13% has been earnings driven. 87% has been driven by multiple expansion or a valuation driven rally. Now, in the long term, this is unhealthy and this is super healthy. But the reason why we're seeing a huge bid up in utilities isn't because the market's going to collapse because funds are getting defensive. It has to do with the tailwinds behind the utility sector. Utility capex is expected to expand from $172 billion here in 2024 all the way to $225 billion in 2027, and then it's expected to stay around about flat all the way into 2030. And this has to do with stuff like AI, it has to do with stuff like EVs, and just general consumption due to stuff like immigration. Funds are seeing these tailwinds and they're getting in early, and they don't mind paying up a little if it means outsized returns into 2025, 26, 27 and beyond. But capital expenditure is dependent on the cost of capital, and the major driver of the cost of capital is actually yields. And this right here is the US 10-year yield average trend analysis since 1963. The average trend of the 10-year yield is up into May and down into the end of the year. When January is up as it was this year, the average trend is up more and longer into August to September, and then lower into the fourth quarter. So this right here is the average trend of the 10-year yield. Now, this is data going back to 1963. You can actually see here that from Jan into May, we normally get upward momentum in the 10-year yield and then downward momentum throughout the rest of the year. But when we have a year when January is up, like we have this light blue line right here, the 10-year yield can actually move higher from January all the way into August, and then from August, September onward do we get the downward momentum we're seeing. This red line is us in 2024, and the 10-year yield has actually consistently gone up. We have seen quite a bit of volatility here in May, and we are starting to see a bit of a rebound in yields, and this is actually completely normal. We normally get upward momentum and quite a bit of volatility into the May-June period, and it could last into the August-September period. So if yields continue to trend up into this August-September period, that's completely normal, well within seasonality. What we would then normally expect is after the September, August, maybe even as late as October, that's when we would see downward momentum. So the movement we're seeing in yields is actually completely normal, well within seasonality, well within history since 1963. And if yields actually do continue to move higher into June, July, August, September, again, completely normal, but do expect downward momentum into the end of the year. And any dip or pullback yields do cause in stocks should just be looked as a dip buying opportunity, because the 2024 S&P 500 seasonal composite cycle by Ned Davis Research, which they place an equal weight on the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle, often sees huge upward momentum after the June-July period. You can see we normally trade up to flat, and then we normally see weakness. The S&P 500 normally comes under pressure in about the May, early June period, and maybe we already got that in the April period, where we normally find a bottom and then continue the rally to the upside. And what normally happens is that we do see vicious up momentum, a rip taking out the highs we previously made, but that does coincide with quite a bit of volatility. So what you want to do is just hold, buy on dips, have conviction, and follow the process. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.